All right, hey everyone. It is Monday, 1:30. Markets just closed. It's good to be back after a week out. Although was less of a week out and more of a stare at the markets from a different location kind of week, given the volatility that we had last week. Right. So this is last Monday right here. I've got December Kansas City wheat up in front of you, and let's just jump right into it. Markets have been extremely volatile on really very little news to speak of. I know we have a lot of chatter out of Russia, but then we have a lot of weather and other issues. So, but really none of this news is new news, right? It's just more of the same, and volatility seems to just be picking up. If I put a longer term chart of Kansas City wheat on the on this thing and went back several 2, 3, 4 years, you'd find very few days that moved 30, 40 cents. Maybe 10% of them. You'd find another 20, 25% that might move 25 cents in a day. And then you'd find a whole bunch that move 10, 15 cents in a day. So if you look back over the last 6 months and you count this up, and I have not done this work, but I would guess that well over 2/3 of them have a daily range of in excess of 25 cents, somewhere between 25 and 50 cents. The ranges have just been extreme, and they just get banged around like crazy. And just when you think that you have something that makes sense, like this day here last Monday that broke up out of the top, and even last Tuesday where we came back down and tested the top of the range, right? That makes sense too, because once you break out of a big range like this, it makes sense to come back and test the top of it. So that day made sense. This made sense. Everything about this breakout made a lot of sense given this upward tilt here with all the higher lows. Once this got broken, we would have expected a bigger move up, but then Tuesday, Wednesday, Thursday, Friday, it just took it all out, and then this morning the route was on really pretty early, even though right at 8:30 we were trading right around this 860 level. So what's going on in the wheat market? I think it's really simple. Nobody knows. There's no rhyme or reason. There's just a tremendous amount of uncertainty, and so the question everybody has in their mind is, are we done? Are we done going up, and are we going to go straight down? I don't think the market just goes straight down given the amount of uncertainty that we have. And I think that applies to corn, wheat, and beans. Even though today was nothing short of, you looked at the chart and it was like, oh my gosh, it's an apocalypse. But you got to look at what we did. We just reverted back to the midpoint of this range. That's all that wheat has done. So we've been in this range for a long time, and the market's just telling us it's not ready to move out of the range yet. What does it have to do to break out to the downside? Well, let's look at its homework, right? It has to break this upward trend line. It's got to break the bottom of the daily cloud. It's got to break these lows. It's got to have lower lows before it can say that it's in a downtrend. And so another day like today would do it, right? If we come in tomorrow and we're down 50 cents and trading down here at 780, then yeah, that's really bad. But over the last 8 days, this is Wednesday. This will be 2 weeks ago this coming Wednesday. So this is 8 trading days ago. So 2 more will be 10. And we've had a dollar straight up and a dollar straight back down. Really no rhyme or reason because the fundamentals didn't change that much. What you have is fear of supply disruption, and you can see what that looks like. So if we do get it, then up and away we go. If it looks like we're going to contract, if it looks like maybe we're going to have an abundance of something, then we're going to grind down and look lower. I think that if we do start to break lower, and I think this applies to corn, wheat, and beans, I think if we break lower, we start to revert to the smaller trading ranges because we're going to be coming down into levels that are historically normal. So I think you're going to stop seeing these big violent swings and start to see a lot more rhythm and a lot more reason to the market if it breaks down. And if it goes higher, I think we see wide price expanse. I think we continue to see the volatility that we've been seeing. And clearly, if we get back up above today's high, which would be 870 on December, then I think you're looking at new highs coming up above this 935 high. But you got a lot of room here to mess around with. So what do you do with that? Well, it's like I've been telling some of you. If you're worried about it and you're super nervous about it, sell it. Just sell it, get the risk off the table. Don't worry about it. You can worry about re-owning it later. The problem is re-ownership is tough because the options are very expensive and the futures are very volatile. So even owning a put and buying futures is risky because the options markets are so expensive. So it's very difficult to trade. It's very difficult to manage. If you're nervous about your risk, get it out the door, or find somebody else to hold your margin for you, even though that doesn't guarantee you a profitable result, right? Because you still have the volatility, you still have the cost. At least it's not coming out of your pocketbook up front until delivery. So if you want to talk about some of that stuff, call us, let us know. We're happy to talk about it. I think, as long as we're holding up above this, call it 8 to 815 range, we're still going to look higher because I don't think the volatility is done yet. But clearly we'll, we very well could be wrong, and I don't think anybody has any idea what's causing it or why it's doing what it's doing. If anybody says they have the full story, I just don't think they're telling the truth. Okay, so this is Chicago wheat, very similar to Kansas City, right? Except maybe a little bit more order to it. Kansas City just gets banged around like crazy because it's not nearly as liquid. But still the same with this market. It looks to us like probably a little bit more bullish than bearish, but we certainly don't want to see these lows down here give way. All right, let's look at soybeans because anybody that traded those today had a great time. Let me clean this chart up so we can see it a little bit more clearly. Okay, so put a couple more things on here. Let's get rid of the cloud. Let's get rid of the Fibonacci retracements. That's too noisy. Sorry, sometimes these charts get cluttered. Okay, so here we have beans, right? You have this big move up. This actually still looks pretty bullish. Today was a disaster, right? Had the big reversal day on Thursday. We are a full $1 below where we traded Thursday at the high on November beans, but regardless, we still have higher highs and higher lows. We have yet to really break anything significantly on the chart other than this big nasty outside day, 1, 2, 3, 4, 5, 6 bar, 6 closed reversal pattern here that we got on Thursday. That was bearish. Now this morning we have this gap. This could be a breakaway gap, could be an exhaustion gap. You just don't know what it is. And so you got to take everything in this action with a little bit of a grain of salt. So I'm going to give you a reference point here to work with, if I can find my indicator. This little red line right here, it's called the TDST line. It's the line from which this move began. I would say anything on a closing basis below this line is bearish. We held it today at the close. I'd say anything above that, you got to lean a little bit more bullish than bearish, but clearly not out of the woods, right? And it's hard to look at a chart and say, hey, we're down 50 cents, that there's anything bullish about that. I get that, and I'm not trying to say that that this is like a strong signal. I'm just saying this is a point at which to trade from. It's objective, it's identifiable, and it's pretty simple. You're either above it or you're below it. So a move below this, you want to get hedges back on. Certainly below this 1320 level, you want to get hedges back on because you don't know where we'll go. You would think we'd come back up and test this gap area at 1380, and then you can make some decisions from there. We'll see what ratings do. They come out at 3 o'clock here. Who knows what they'll do. But it seems like we put risk premium in on war and disruption, and then we just rip it out on any type of good weather forecast. And remember, this sell-off happened in the face of over 50 million bushels of soybeans being bought last week by China. So you had a demand resurgence and somebody finding value at $14, but yet we sell the market off anyway. So who knows? Maybe the Chinese and traders got emotional at the weather forecast back here and decided to start buying. Maybe there's some underpinning demand that we don't know about. You just don't know, but it is never good when you have a big set of bullish news like, hey, demand is here, and you trade negative. I mean, if you think about it, what has been the biggest problem with beans and corn? Well, it's been demand, right? Our export pace is slow, and so everybody says it's not there, and now it shows up and we sell it. So this is very counterintuitive. It doesn't make a whole lot of sense. So we're going to try to keep it simple, and we're going to use kind of this 1325 level as a reference point and a pivot point. And as we trade below it, we want hedges on, and we're going to be just protective. If we trade above it, then we'll see what happens, and we'll kind of watch price action as we get back up into this level. Anybody's guess yet as to what's going to happen, and because nobody has the clarity and certainty, I still think that price expanse and volatility could and probably should remain in place. Okay, here is December corn. December corn was off 18 today. Really, it didn't trade too terribly bad relative to beans and wheat, although we did leave this gap here on the chart. And talking to some of you, what is this? Is this a breakaway gap? Is this the measuring gap? Is it an exhaustion gap? And the answer is we don't know. If it's a measuring gap, it counts somewhere down to the 470 level. If it's a breakaway gap, then we have no idea where it'll count to, but significantly below this level here at 481. If it's an exhaustion gap, then this blue 2 and this Fibonacci retracement will hold and will pretty much be up and away really quick. So how much room does corn have to go to the downside? I don't think a lot, given our condition rating and given just everything else that's going on in the world. I don't think we have a huge amount of downside, but certainly with this setup, we could go ahead and accelerate lower for now. But I think somewhere in this, 5 to 475 level should catch it and should provide quite a bit of support moving forward. So one other thing to point out here, you can see where we've stalled out here right at the 61.8 retracement level from this move up. The only downside is that if I snap this in reverse, where we stalled on this rally was the 61.8 retracement on the way back up. So corn's caught in no man's land here. It's caught at this between the two 61.8s with wave 2 in the bearish position and wave 2 in the bullish position. It's anybody's guess which way this thing really goes, really does decide to move out of, but for sure it's probably going to. But for now, it's just really difficult to get your head around which direction we're going to go because we're pulled so hard in so many different directions with all of the fundamental pieces that are out there, right? So we just got to be patient, let price action be our guide. I think this 502 level is what holds it here because we do have 5 moves up. We got 1, 2, 3, 4, 5. Now you would think that then what would follow would be a 3-wave move down, and this could be the end of wave A. We come up here and then we get a B, but I really think this 502 level should hold because that is the apex of the prior wave 2. You can go all the way down to here and still maintain that wave count, but you would like to see it bounce and move forward and move higher quicker or sooner rather than later. So we'll see what happens. We'll see how it unfolds. So if you're nervous, get protection on. If you're nervous about the upside, get protection on, right? It's not wrong to own calls and it's not wrong to own puts. No one's going to second guess those decisions for a second in these environments. There's a lot of volatility yet to come and a lot of opportunity yet to come. So with that, I'm going to wrap it up. Remember, there is always risk trading futures and options, and you should only do so in light of your own financial condition. We are happy to help you analyze the risk and answer any questions that you have. If you want to chat, give us a ring. Otherwise, we'll talk to you later. Have a great night. See ya.